A tariff takes one signature to impose. It takes one signature to lift. That's the whole mechanism. A single office, a single afternoon, and the entire trade relationship between two countries can flip. A trade agreement doesn't work that way. It takes years of negotiation, a phase-in schedule measured in decades, ratification votes in multiple parliaments, and, most importantly, thousands of individual businesses quietly rewriting their supply contracts around the assumption that this new relationship is the stable one now. In the first 5 months of 2026, 3 of those slow, sticky, multi-year agreements got signed by countries that used to build their trade strategy around Washington. None of them needed the United States' permission. None of them are going away if a tariff rate changes next quarter. And that mismatch, between how fast a tariff can move and how slowly a trade agreement unwinds, is the actual story here, not any single policy decision. This isn't a new observation dressed up as one. Economists have been measuring it for decades. The Federal Reserve's own Trade Policy Uncertainty Index, built by tracking how often trade policy and the word uncertainty appear together across major newspapers, goes back to the 1970s. Footnote 1. It spiked after Nixon's trade shocks, spiked again during 1980s tensions with Japan, spiked around NAFTA in the mid-1990s. It has been sitting at unprecedented levels since 2016, and it keeps spiking higher. Footnote 2. The tool exists because the pattern is old enough to have a 50-year paper trail. Here's what that uncertainty actually does, mechanically. A joint analysis from the Eurochamber's chief economists group found that trade policy uncertainty's effect on business investment isn't immediate. It's delayed and cumulative. The longer uncertainty persists, the larger the estimated damage grows, which means the full cost of today's unpredictability may not show up in the data for years. Footnote 3. That's the heart of this episode's argument. The harm isn't confined to the period when the policy is actually in flux. It keeps compounding after the fact. And businesses have started planning around that delay instead of waiting for it to resolve. Deloitte's 4th annual Attitudes to Trade survey of UK business leaders found 83% expect trade disruption to continue for at least 1 to 2 more years, and 54% expect it to continue for 3 to 4 years. Footnote 4. That's not a company waiting out a news cycle. That's a company building a multi-year operating assumption into its actual planning horizon, which means the relationships it forms during that horizon are built to survive whatever happens to the specific policy that triggered the planning in the first place. There's already a concrete, dated example of what that looks like in practice. When the United States ended its $800 de minimis exemption in August 2025, postal operators across Germany, Denmark, Sweden, Italy, and later France and Austria suspended US-bound shipments entirely, with restrictions lingering well into 2026. Footnote 5. In Thomson Reuters' own survey, 72% of respondents named U.S. tariff volatility the year's most consequential regulatory change, up sharply from 41% just 1 year earlier. Footnote 6. Once a shipper builds the customs documentation and carrier relationships to route around a specific disruption, that capability doesn't disappear just because the disruption that caused it does. The rerouting becomes the new normal operating procedure, not a temporary workaround. That's the actual mechanism behind trading without America. It was never really a story about anger or retaliation or any single administration. It's a story about the fact that trust, once a business has to build a contingency plan around its absence, doesn't fully return just because the specific policy that broke it gets reversed. EU India, the landmark case. Announced January 27, 2026, after nearly 2 decades of on and off negotiation, the agreement creates a free trade zone covering close to 2 billion people. The EU will eliminate or reduce tariffs on roughly 96.6% of its imports from India. India will cut duties on roughly 99.5% of its imports from the EU. Footnote 7. Modi called it India's biggest and most historic free trade agreement. The contrast writes itself. At the same moment this deal was concluding, US-India trade talks remained stalled, with the US still applying roughly 50% tariffs on many Indian imports. Footnote 8. One relationship took 20 years to build and is now locked in. The other is stuck at a punitive rate with no resolution in sight. India didn't choose between the two, it simply stopped waiting on one of them. EU, Mercosur, the scale case. Signed January 17, 2026 and enforced by May, this is the largest block-to-block trade agreement either side has ever concluded. The EU cutting import duties on 91 to 92% of Mercosur exports over a 15-year phase-in. Footnote 9. 15 years is worth sitting with. That's a timeline that will outlast 3 full U.S. presidential administrations regardless of who wins any of them. The EU is already Mercosur's largest investor, with roughly $467 billion in existing trade stock underpinning the relationship before this agreement even took effect. Footnote 10. This isn't two economies testing the water. It's two economies formalizing a relationship that was already the dominant fact on the ground. Canada, China, the limits case. And here's where the pattern runs into a wall. In mid-January 2026, Canada and China reached a narrow deal, not a full free trade agreement, just targeted tariff reductions on Chinese electric vehicles and Canadian canola. Footnote 11. Prime Minister Mark Carney traveled to Beijing to announce it personally. Within days, President Trump threatened a 100% tariff on all Canadian goods if Canada went any further, warning that China will eat Canada alive. Footnote 12. Carney's response came within 48 hours. Canada has no intention of pursuing an actual free trade deal with China, he said, noting that Canada is contractually bound under USMCA not to sign free trade agreements with non-market economies without prior U.S. notification. Footnote 13. That's the reframe this section needs. The EU didn't need permission to build a 2 billion person trade zone with India, or a 15-year agreement with Mercosur. Canada, bound by treaty to its largest trading partner in a way the EU simply isn't, tested the same instinct and hit a wall inside 48 hours. The realignment pattern is real. But it isn't universal and it isn't unconstrained. It depends entirely on how much treaty-level leverage the country testing it still has left to lose. Worth naming honestly too, not every version of this story is defensive. A recent supply chain survey found Chinese executives notably more confident than the global average. Only 42% describe policy uncertainty as high, against a 53% global average, with direct Chinese exports to the U.S. now under 3% of China's GDP, down from over 6% a decade ago. Footnote 14. For China specifically, this diversification predates the current tariff era. It would likely be happening anyway. Not every trading partner in this episode is reacting to the same shock at the same speed. Every door has a locked room behind it. This one is shaped like a lever that moves easily in one direction and barely at all in the other. A tariff is imposed with a signature and lifted with a signature. The businesses on the receiving end don't get that luxury. A company that spent 18 months rerouting its supply chain around a specific tariff doesn't reroute it back the moment that tariff is lifted. Not because it's being stubborn, but because rerouting cost real money the first time, and there's no guarantee the policy that triggered it won't simply return with the next administration, or the next mood swing from this one. The rational move isn't to bet on stability returning. It's to treat the instability as the baseline and build permanent infrastructure around it. This is the 16th distinct locked room the show has documented, and it's built from asymmetric reversibility rather than scarcity, diffusion, or an institution with no defendant. The door swings open easily. It just doesn't swing shut the same way. Categorized honestly against all 15 prior variants. Every other locked room on this show has been about something staying stuck. This is the first one where the thing that's stuck is actually the fix itself. The policy reversal that's supposed to restore the old relationship, arriving too late and too uncertainly to actually undo what business is already built around its absence. Flagged for host confirmation. 3 deals signed within months of each other, all built to outlast the specific policy dispute that provoked them. That's not a coincidence, it's the visible result of the mechanism Section 1 built. Businesses and governments both operating on multi-year planning horizons that don't reset just because a headline changes. The stakes compound from here. If trade policy uncertainty really does have a delayed, cumulative effect on investment as the Eurochamber's analysis found, then the full economic cost of this era of volatility hasn't actually landed yet. It's still accumulating quietly in decisions that won't show up in a quarterly earnings report for another year or two. That connects directly to Episode 22's diffuse inflation story and Episode 21's export control reversal. 3 different mechanisms, 3 different sectors, the same underlying pattern of costs and consequences that outlive the specific policy that caused them. Who benefits from that lag is worth asking plainly. The EU gains two locked-in multi-decade relationships it didn't have a year ago. Countries with less treaty leverage than the EU, Canada chief among them, remain constrained by the very agreements meant to protect their access to the US market in the first place. And the businesses caught in the middle of all of it are the ones actually paying for the uncertainty, whichever government eventually wins the argument. A tariff is a policy. A trade agreement is an institution. Policies change with elections. Institutions, once built, tend to outlast the people who built them, and increasingly they're being built by everyone except the country they used to assume it would always be at the center of the table. The next chapter of this story isn't really about tariffs anymore. It's about who controls the physical choke points, the canals, the straits, the ports, that all of this reshuffled trade still has to move through, no matter how many new agreements get signed around it.